These economies are collapsing. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, two major countries are on the verge of an outright economic crisis, and I want to understand why the rest of the world will soon follow them down. And we're going to take a look at what the experts are predicting the fallout will be, and it will make perfect sense why we're headed to a globally synchronized recession. Now, you might be wondering what we're doing in Philadelphia today, and unfortunately, it's not to get a delicious cheesesteak. We're going to take a look at their manufacturing sector here because I want to understand that why there's this broad belief that the U.S. manufacturing, the U.S. economy is bottoming out. We're about to achieve the soft landing, and then by the end of the show, I'm going to show you exactly why that there's no truth to that at all, why things here are going to follow these two other major countries down. Let's over to the Philly Fed, where we picked today's story up with their manufacturing business outlook survey. And it noted that manufacturing survey in the region continued to decline overall. This is according to firms responding to the July manufacturing business outlook, and that was between the 10th and 17th of this month. The survey's indicators for general activity and new orders remain negative. Furthermore, the index for shipments declined and turned negative. That's not good either. The employment index suggests mostly steady employment overall, while the prices paid index remains below its long-run average. So let's unpack some of this right now. What we're seeing is kind of stagnation in the Philly Fed manufacturing sector right now. What they're suggesting, though, is employment is remaining steady, and we've talked about this in the past, that employers right now are believing the Fed. They think that perhaps this mythical soft landing is going to happen, and that perhaps they're just going to have to just take a little bit of pain because they don't want to rehire people back and retrain them when the economy surges into the later in part of the second half of this year. Of course, I'm going to make the case why none of that's going to happen, and in the end, a lot of these employers are going to be laying off anyways. More future indicators improve, suggesting optimism, which we know everyone is optimistic about the future, but the reality is it's not going to happen at all. Let's take a look at the details of the report here because we see general business activity. It's in contraction, minus 13.5. Now, I'll show you on a chart here in a moment, but I just want you to understand some of what we're seeing is you see new orders. You want to know where growth is headed in the future? You look at new orders. You want to talk about demand and inflation? You look at new orders, because if new orders are going down, that means demand's falling. Demand's falling, inflation comes down. The only question is, how long does it take to come down before the Fed goes too far? Well, they're probably about to go too far on Wednesday, but we'll cover more of that then. Shipments down, unfilled orders. Remember, this is your kind of pent up demand, the backlogs, those are shrinking too. So what's happening here is as new orders come down, companies are being able to go through their unfilled orders or backlogs and start to clean them out. Once those are gone, well, you won't need as many employees. Delivery times are down. Prices paid are slowing. There's your inflation component. The only difference is the number of employees are pretty much steady. The average work week's down a little bit, but that's not really important at this time. I think we'll see a shift of that, but normally we see a lot of optimism in the future. So what I want you to see on this chart, this is a general activity for the Philly Fed. This is the data now in chart form. And what do we notice is that in periods where there's a recession, you see those gray lines, you see downturns in the general business activity index. And it doesn't go in a straight line. And that's really important because people are looking at this right now. And if you want to know why there's this kind of belief that perhaps the worst is behind us, because look across the chart and you can say generally or approximately at the current levels where the general business activity index is, it says, hey, if we're not at a bottom, we're pretty darn close. And so that means the worst is almost behind us. That's what gets people optimistic about the stock market, optimistic about the future of the economy, is to say, you know what, it's pretty bad right now. There's just no way it can get worse. But can it? Here we can see now we're going to overlay the new orders against that. Now, I know this is really noisy because the general business activity index follows new orders with a very slight lag, and new orders, of course, very noisy, and the general activity business index very smooth in comparison. What I want to point out is there is a strong relationship between the two. Well, obviously where new orders go, activity goes, but new orders have turned down. Now, I know it's hard to see here, but they've turned down here. So what's interesting interesting to me is when we talk about inflation, and there's this big belief, we'll hear from the Fed again on Wednesday, that they think inflation's still too high, we need more tightening, they're probably going to raise rates, and then they're going to threaten to raise them some more. But what I want you to see is the manufacturing index does a great job of telling us where inflation is going, which tells us where the economy is going. And then, of course, as we start to look forward to these other countries, when you see their data, this will all start to make sense of where inflation and growth in the world are actually headed. So here you can see, as we look at this general activity index, knowing that new orders led this down, here you can see back in the 70s, the factory index went down, and then with a lag, inflation followed. You saw it here in the late 70s into the early 80s, manufacturing sector down, lo and behold, eventually inflation comes down. You see it again here, late 80s into the early 90s, slow down the manufacturing sector, lag, inflation down. Again, into the dot-com bubble, same thing happens. Global financial crisis. Once again, the two, you see them together, CPI following the general business activity index. And look at this, you see it happening once again as activity of the factory sector goes down, consumer price goes down. So what this tells us is that with a lag, we should see inflation cool off and more than likely hit the Fed's target. But of course, the Fed, they're not going to buy into that at all. They're looking for an immediate reaction. We know that's just not how the economy works. But there was a special question in the Philly report that I want to take a look at. How have wages and compensation changed at your firm over in the past 3 months? Look at this, they've increased 57.5. So many of you might say, wait a minute, and we know the Fed says this too, is wait a minute, if wages are going up, come on, Steve, demand's going to have to turn around. This is going to be that, wage price spiral inflation the Fed's worried about. Well, until you see the next chart that says, look, they could raise wages all they want, but that's not the likely outcome of what's going to happen, because of why some people may get raises, other people are going to get pink slips. And here you can see the current general activity index again in blue. Now we're overlaying the 4-week moving average of initial claims. And as business activity falls in the factory sector, what we expect to see is initial claims rising. We see them over and over and over again. And now we're kind of at a point where everyone believes that they're going to pull back now that we've gone through the worst of this kind of rise in initial claims. The factory sector, or at least from what we know of new orders, which are actually headed down as, again, those backlogs get filled and new order demand goes, you finally start realizing you've got employees standing around doing nothing, and after a while, you put them on the unemployment line, and that's why we're going to see a rise in initial claims. Now, the other factor here is, again, as we get into what's going around the rest of the world, I wanted you to understand the setup here of the relationship between these factory sectors of inflation and employment, because it's absolutely critical. And top Euro area economies flash recession warning signals, and this is really bad news, but one thing that shouldn't be following a recession signal is your trading account, because had you signed up for CTA-Timer Pro, many of you have been asking for an update on QQQ. Here you can see this is where the initial buy signal was triggered, way down here when no one was really bullish on stocks, and now lo and behold, it took off. The signals gave you a second entry point. During this pullback, the report said, hey, pull some of this gains back, and then it said take off out of here. If you missed the first one, it said to buy in here. And in this area here, it kind of said maybe take some profits, and then it accelerated out of that and said buy back in a big way. And set up here, we talked about this, raise your stop loss levels up, and we're seeing a pullback now. Doesn't mean that we can't see the Qs go higher. It just means potentially you got to raise your stop losses. There could be a reversal here, and some of you are saying the report won't nail it. I'm telling you, you're going to watch it, you're going to see it. Here it was, January 9th. We were almost at max short position. We tell our subscribers in our guidebooks that when you see a near max position on reversal, you look for the fast side to start short covering, take your position, put a stop loss, add into it if it goes up. Here you can see that pullback on March 15th. And over the weekend, we do put, twice a week, we put updated lists to say these are the ones you should focus on your hot list. It's a mere $1 a day, $30 a month. Link in the description below. Check it out. because the S&P Global's Flash Purchasing Managers Index for Germany, now get this, dropped to the lowest level this year with a July reading of 48.3. Now, what I want you to understand here is they're reporting the composite, and this is really important because I'm going to show you the actual report where the manufacturing sector number is. So they're trying to blend the manufacturing and services sector data here, because what is the broad belief is, don't worry about the manufacturing sector right now. The services sector in every country around the world is strong, it's robust, it's going to drive the economy out of this and pull the manufacturing sector up. Now, that almost never actually happens in the real world, but that's the belief right now. What I'm trying to show you in the data here is, as the manufacturing sector slows, jobs are lost. Those are relatively high-paying jobs, and that matters in a big way to the economy. But I want you to see kind of how the Bloomberg reporters are covering up the real dire part of this data. So we see a July reading of 48.3, which shows a mild contraction, because below 50, the threshold is where it indicates, above 50 is where it indicates growth, below 50 is a contraction. So you see, okay, 48.3, mild contraction, not a big deal here. This is slight, this is nothing. How about this? France, even worse, hitting a 32-month low of 46.6, but yet Germany's situation is far worse, as you're about to see. So at this point, we have two major economies, two major countries seeing contraction on both the manufacturing and services when you blend them together. Of course, the economists said this was worse than any of them predicted, and of course that's because nobody actually believes anymore that the manufacturing sector leads the services sector, and with a lag, and that's just like inflation. But again, you'll notice people don't believe it until they see it. In Germany, the negative reading was driven by manufacturing. Now, what you see here, they don't tell you the number. There's a reason why, which has been below 50 for more than a year and is now near levels last seen during the start of the pandemic in 2020. Growth in the services, oh, look at this, slowed for a second month. So just think about this. The manufacturing sector in Germany is as bad right now as it was during the onset of the pandemic, when the global economy was effectively shut down. And this is critical to understand just how bad things are there. So let's take a look at the details, which of course Bloomberg didn't bother to give us. As Germany PMI moves into contraction territory in July, here we can see at 38.8. This isn't just recession level, this is depression level, 38-month low in the manufacturing sector. Now, one way to look at this is says, look, maybe that's the bottom. It can't get any worse. Germany's manufacturing sector is essentially bleeding in the street here. I mean, how much worse can it get? Well, wait till you look at some of the details. It's going to blow you away. Over the last few months, these are comments from the report, we have seen jaw-dropping fall in both new orders and backlogs of work. Now, what do you now know about that? What should we all see in this report? That it means unemployment is going to go up there. That's what we should see. So we're seeing these factories saying, look, we're clearing out all the backlogs, and well, there's not a whole lot coming in beyond that, which are now declining at their fastest rate since the initial COVID wave at the start of 2020. Manufacturers are reacting to the drop in activity and new orders by starting, here we go, to trim their workforces for the first time since January 2021. And look at this, hopes for a rapid slowdown in inflation have taken a hit with these latest findings. So one thing, now does it make sense like why we went through the Philly data first? Because I wanted you to see that inflation falls with a lag. I wanted you to see that unemployment falls, a downturn in the manufacturing sector, and all of that spells an eventual recession. But the issue we have here is central bankers around the world say, look, inflation's just not falling fast enough, so we need to do more. And at the end of the show, you're going to find out why more is not better for where we're headed. How about we head over to France now? Look at this. Business activity in France declines at the fastest rate since November 2020 as contractions in services and manufacturing worsen. Now remember, we've been told services sector is not going down. Look at this. French manufacturing PMI solidly now recession data below 45. We see 44.5, 38-month low. Again, that could be viewed as perhaps the bottom until you get to the comments. The French economy took another hit in July as both the manufacturing and services sector saw a decline, showing the sharpest reduction, get this, in business activity since November 2020. How about down here? Conversely, sentiment in manufacturing appears more restrained, where firms are pessimistic toward the next 12 months. So if we're looking for a rebound here, well, we're not seeing it in the Eurozone at all. And that, my friends, is dire, because these PMI readings for the Euro area's two biggest economies are a warning for the region as a whole, suggesting that where Germany and France go, the rest of the Eurozone will follow. And where the Eurozone goes, if you don't think Asia, you don't think US and other major countries can follow them down, well, they will. Let's take a look at the Eurozone data, and then we're going to get to the US. Here we can see Eurozone business output fell at the fastest rate for 8 months in July, according to the latest HCOB Flash PMI survey data produced by S&P Global, making a weak start to the third quarter, setting up a fourth quarter recession if they're not already in one, which they are, but no one wants to admit. Deteriorating forward-looking indicators such as future output expectations and new order inflows also point to the likelihood of a downturn deepening in the coming months, prompting companies to pull back on hiring. Prices pressures meanwhile moderated further, with average selling prices rising to the slowest rate of almost 2.5 years. So get this, it's going to get worse is what they're suggesting here. And now let's head over to the US, because in the US we get things kind of also with a lag, but toward the end of everyone else's downturn. Why? Because we are the world's largest importer. You'll notice a lot of these are export centered. You see the German manufacturing sector. That's what's critical here. Now let's head over to the US. And what we know is the PMI composite for the U.S. showed a mild, just a slight expansion in the U.S. economy at 52. But look at the manufacturing output. After last month, which saw a decline of 46.9, a contraction, all we get this month is just stabilization. Well, we went down last month in demand, and it didn't get any better, but it didn't get any worse. That's the key here. Look at this. Supported by producers relying on backlogs of work and a shallower drop in new orders. So there you go. We now know that means unemployment eventually coming, and increasing that eventually coming to the U.S. as constraints on client spending, including higher interest rates, reportedly dampen demand. Well, we see that already. Look at these comments. July has seen an unwelcome combination of slower economic growth, weaker job creation, gloomier business confidence, and stickier inflation. But we know inflation follows with a lag. So the idea here that inflation is sticky is okay, because in the coming months, it should be very unsticky to the downside. But yet, again, don't tell that to the Fed on Wednesday. Growth is being entirely driven by the services sector. Well, not for much longer, as furthermore, business optimism about the year ahead outlook has deteriorated sharply, not something you want to hear, to the lowest seen so far this year. And here we can see, we'll keep alive the fear that the U.S. economy yet may succumb to another downturn before the year is out. It's almost now a certainty if it wasn't before. It sends a worrying signal that further falls in the rate of inflation below 3% may prove elusive. It says in the near term, right. Probably not in the next month, but over the next couple months, we should see inflation come down, and yet the Fed is all teed up to keep hiking. As U.S. economic soft landing hinges on the Fed's tolerance for inflation. After taking a break from tightening credit last month, Fed Chairman Jerome Powell and his colleagues looked locked into raising interest rates, because we've talked about why they've all talked the fact that they're going to want to raise another 0.25%, so they backed themselves into a wall. The aim to slow the economy enough to reduce inflation to its 2% target over time without crashing the U.S. into a recession. What you're going to see here in a moment is why that coming back to that Philly Fed data, why everyone believes that perhaps we're at the bottom here, that it can't get worse. And I'm going to show you why it's getting worse, and why the same reason is projected to get worse in both Germany and France, and that will take the whole Eurozone down with it, U.S. not far to follow. The big question facing policymakers and financial markets is what comes next? Well, I can tell you it's going to be a recession, and an ugly one. But former Fed Chair Ben Bernanke said that this week's rate increase may be the central bank's last in a credit tightening campaign that's already seen rates rise by 5 percentage points. But a lot will depend on how much inflation the Fed is willing to accept and for how long. And as you're about to see, they're not going to have to accept it for a whole lot longer, because we already know that inflation falls in manufacturing sector sector down with a lag. Now the question is things going to get worse for the U.S. manufacturing sector before they get better? The answer is yes. And here you can see on this chart, we've got the yield curve shown in red. That is against, of course, general business activity for the Philly Fed. And what I've shown you in this dotted green line where the inversion is. And what I want to point out is that we can be coming out of an inversion. We can see a steepener of the yield curve where rates are falling. And it's not until you see a significant decline in rates that the manufacturing sector starts to heal. You see it right here in the early 80s. How about we look around 1990? It took the curve steepening for a couple years before the manufacturing sector started to heal. Same thing kind of in the dot-com bubble. Took a while for rates to get down low enough for everything to start to work itself out of the system. And we see that happening again here in the global financial crisis, meaning rates need to come down a lot. And here we can predict already the Fed is going to further invert the curve on Wednesday. And that means that for the U.S. manufacturing sector, things are getting worse, and any sign of recovery could perhaps be a year or more away, depending on how fast Fed gets rates back down and takes them below the zero bound where we're at before. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.